Hey guys, it's Kiki the Adjuster, aka Miss Make It Make Sense, and today we're breaking down the different types of insurance companies in a way that actually makes sense. Whether you're studying for an exam or just trying to understand what your agent is talking about, this video is for you. So let's get into it. First, let's talk about the different type of insurance companies. First up, we have a stock insurance company. So stock insurance companies work like this. Imagine a lemonade stand, but instead of selling lemonade, it sells insurance, of course. And instead of just one person owning the company, a bunch of people buy pieces of the business. Those people are called stockholders. They invest their money and expect to make a profit. So when you pay your premium, part of that money might end up going to the investors, not you. That's how a stock company works. Owned by stockholders, run for profit. So next up, we have mutual insurance companies. Now, imagine this lemonade stand again, but this time it's owned by the customers. They pay to keep it going, and if there's any money left over, it goes back to them. That's what usually makes it mutual. The customers are also the owners. They might get dividends, lower premiums, or just a better experience overall. It's a we all win together type of setup. A third type of insurance is known as reciprocal insurance. Now let's talk reciprocals. Let's say a group of friends gets together and says, if something happens to you, we got you. That's what reciprocal insurance exchange is. A group of people or businesses agree to cover each other's losses. They're not a company, they're a group, and they're managed by someone called an attorney in fact. That's just a fancy name for the person handling the money and the paperwork. Everybody in the group is both a member and an insurer. It's mutual protection with a little help from a manager. Now it's time to get a little bougie. A fourth type of insurance company known as Lloyd's Association or Lloyd's of London is not a company, it's more of a marketplace. Picture a big historic building where wealthy people and businesses team up to insure weird, wow, one-of-a-kind risk. Think celebrity body parts, spaceships, the Super Bowl, you name it. Inside Lloyd's, you've got syndicates made up of members who agree to take on these big risks together. They don't do your regular home and auto. Lloyd's is for the 1% of risk. Think like getting insurance on Beyonce's voice or something like that. A fifth type of insurance is known as a fraternal insurer. Now, fraternal insurers, think of church groups, cultural organizations, or social clubs that offer insurance to members only. They're not for profit, they give back to the group, and the focus is on their shared values, support, and community. If your grandma's church offers life insurance, there's probably a fraternal insurance company. Now let's talk risk retention groups. Imagine you're in a profession where insurance is expensive or hard to get. You and other people in your field decide to just team up and create your own insurance group. That's what the risk retention group is. A group of businesses or professionals in the same industry who put their money together to cover liability risks. Think doctors, truckers, contractors. It's like if we can't find it, we'll build it ourselves. The last type of insurer is known as a self-insurer. These are big companies or just wealthy individuals who say, you know what? We'll just pay for our own losses out of pocket. No traditional policy, no outside company. They set aside money and cover their own risk. It's a bold move, but if you got the money, it can work. All right, let's recap really quickly. Stock meaning it's owned by stockholders and it's for profit. Mutual, owned by policyholders, the profits are shared. Reciprocal, group exchange, managed by attorney in fact. Remember, Lloyd's is a marketplace, not an actual company that insures things like space flights and Beyonce's voice, things like that. Fraternal is membership-based. They're usually nonprofit and they support their organization and communities. And risk retention is industry-based self-insurance group. And finally, self-insurer. Pay for your own risk directly out of your pocket. And there you have it. 7 types of insurance companies explained in plain language with real-world examples. If that helped you make sense of insurance, go ahead and hit that like, subscribe, and tap that bell so you don't miss the next breakdown. I'm Miss Make It Make Sense, and I'll see you in the next one. Stay smart and stay covered.